Hello. So today we are talking about accessing funds from your insurance policy. And Glenn, thank you so much for joining me today.
My pleasure.
I think this is going to be a fun topic. And for those who don't know you yet, Glenn is a financial advisor as well as an authorized infinite banking practitioner, and he offers customized service to help you be more efficient in your finances in life. And if you have any questions, you can always put in the comments below and reach out to Glenn, and he would be happy to answer your questions. So Glenn, as we get into this topic, I just give you the floor and let you open up and let us know what's going on today.
All right. So Genese, you know what? Thank you for that. We did 4 weeks prior of where to put your money in Canada. We talked about the RSP on week 1, tax-free savings on week 2. We talked about insurance on week 3. And then last week, we kind of delved a little bit more into the insurance, right? And this week, we're going to talk about, now that you've built up this money, how do you access it, specifically the money in insurance? And the reason for that is with the RSP, whether you want to or not, by age 72, you have to take it out. You have to take out a minimum, right? Like for almost 5%, and it increases each year. You have no choice in that. But if you want to access it, the only way to do that is through withdrawals. Similar to TFSA, you don't have to take it out by 72, but when you want to, you're going to access it by withdrawals. The money in your policy, however, you can withdraw. That's not as efficient as you would think, or you can do via loans, right? So it's a few more.
Loan.
Go ahead, Genese. Sorry.
Well, Glenn, that doesn't sound right to me. I mean, like, I've put all this money in my insurance policy. Why should I borrow no, this is my money. Why should I borrow my own money? Why do I have to take a loan from my policy?
Very good question. And I love using houses, so I'm gonna throw it to you in this way. So you've built up all this equity in your house. Let's say you've paid it off. You don't even owe anything. How do you access it? Do you go break out a window and go sell it? Or how do you access the money in your house if you don't want to sell the asset and stop the growth? How do you do that? You do it via a loan, right?
You sell the house.
Well, you could sell the house. And that would be, hey, you could sell the house, but you're still gonna have to figure out somewhere to live. You'll no longer have access to any growth that that house has, but you've got your cash and your cash in hand. Well, how would most people who know they have an option access cash? They'd either take a line of credit, HELOC or otherwise, secured line of credit, or a loan, right? So really, it's not that we have an issue with loans so much, it's just an issue thinking of loans from an insurance policy, because you're still borrowing money from your own house that you built. You built up all that equity in, but it seems to be less of a bother, right? Now, I'll show you why it's more efficient to do a loan with an insurance policy. So for example, let's say I go to my policy, I don't know, I've got $500,000 cash built up. Maybe my death benefit's about 800,000 or $1 million, just throwing out some numbers. So if I wanted to access, I don't know, say 50,000 or $100,000 from my policy. So if I withdrew 100,000, my death benefit doesn't drop by 100. My death benefit would drop by more than that, possibly up to a couple 100,000. So even though I'm not taking a loan, I'm really damaging my legacy, right? Because I'm taking off more out of it than I need to access the same dollars. Also, depending on the time of life, if I go and withdraw money from my policy, it may all be taxable. And we're talking taxable like money coming out of an RSP, like income, right? So at the end of the day, money is going to go out of my pocket. Now, do I want out of 100,000, okay, $360 going, 336,000 going to the government? Would I feel better if it's called tax? Not particularly. Now, here's why a loan's more efficient. If I can get a loan, okay, from my policy for 100,000, and let's say I'm gonna go crazy and say our loan rate is 10%, more than double what it would, it'd be to get a loan right now. It's a loan, but how much money do I have in my pocket as opposed to the other scenario? Do I have technically 90,000 left over? Or, do I feel good with the 60 plus thousand, $63,000? So whether it's taxation or loan, it's money that's going away from me and my family. I would much rather pay the loan interest than pay the taxation because I get more net money in my hands. Now, this compounds in a few different ways, Genese. When we're retired, let's say I had a job where I had a pension. Beautiful thing. That money is going to be taxable. My Canada pension plan is, guess what? Taxable. The money I had in my personal RSPs, guess what? Taxable. My old age security is, guess what? Taxable. And depending on how high all that taxable income goes, I might start getting clawback on my old age security. Now, a lot of people be like, we don't care because that's going to affect mostly rich people. Well, you know what? Here's what I've learned dealing with clients at all ends of the spectrum. Rich people don't like missing out on that money either, right? They don't want to have a clawback because they did better than the average person. They don't want to be penalized for that, but you don't have to be. Because just like we try to use RSPs to get lower taxes during our working life, and our accountants help us to find out ways to structure things, how we structure access makes a big difference. So if I can go access mine via loan and not have that money count towards income and get more cash in my hand, more tax-free income, and also not have a clawback on my old age security, I'm thinking that's just being smart, right? I'm just thinking that's just being smart because at the end of the day, the rich don't get caught up in categories. They get caught up in what can I access and how much can I keep? And that is why they are where they are. What you want to call it, whether it's a capital gain, interesting, whatever, how much can I keep out of my money? And what's the most I can keep by accessing my money? And it's doing it in a more in a smarter way. Really, it is. Now, something else, when you don't withdraw the cash, as I'd mentioned in the policy, if I withdraw the cash, then my death benefit drops by more than the cash withdrawn. I get to access all this money during my lifetime, and my death benefit, and I'm talking about participating whole life at this point specifically, my death benefit keeps on growing each year dividends are paid out. So I have access to cash. My cash value actually still grows within the policy, as does my death benefit. So I'm getting it on every single front that I can, as opposed to shooting myself in the foot by getting caught up in, I don't want to take a loan, right? That's a poor person mentality, right? And that with respect, those who feel that way, I get it. There's a lot of people who've grown up saying no loans, no loans, no loans, and it's served them better than the average person, let's face it, in this country by not getting in a lot of excessive debt. But I got to ask, for those of you who had that mentality and who bought a house, how many of you bought it cash? I'm going to say not more than half. And I'm being very generous there, right? So at some point, you had to deal with a loan. You had to deal with some quote unquote debt in order to get yourself and your family further ahead. This is no different, right? You've established an asset, and we're just looking at the most efficient way to access funds out of your asset. That really is it. You know? So I mean, what are some of the things you think people might come up with and say, well, loan, what does that mean? You know, what are some of the things that come across your mind? And I mentioned loan, Genese.
Well, I think about everything, but I'm just thinking everybody have their way of thinking in terms of there are some persons who just believe in no debt at all. So they don't even have credit cards, right? They believe in cash. So for some persons, they will say that absolutely no loan, no borrowing at all. So everything they want, they save up, they have their cash, right? They have their emergency fund, they have everything that they need. So I'm just thinking that for some persons, a loan is a loan. They just don't want it at all, right?
You know what? You're right. I know quite a few people who are that way. And that mindset is so much a part of them that even when I present stuff like this, it's not going to break them. But here's the beauty of life. It's a choice. I offer you a choice. If the other one makes more sense for you, for your situation and your how you feel, then you do a withdrawal. Most of the people I'm dealing with, though, when we start getting to the point where we go, this is money you've built up, you can access more of it via loan and leave more of it to those you love because you've done a loan. Where would you rather go, right? And in a case like that, most will go for the loan. Again, some will still do the withdrawal. And the beauty is it's always your choice. You're not forced one way or the other, right? So it's just ways to access things and do it more efficiently. And I like efficiency, especially when efficiency means more money in my pocket for taking out the same amount of money. I love that option, as most of the clients I deal with. But again, as I said, for those who are just wired that way, and typically it serves them well throughout life, typically, then guess what? You still have the option. That's the beauty of it. Access, and the way you access comes down to you. Now, when I say it comes down to you, I truly mean it comes down to you. Because here's the thing. Let's say you're retired, no income coming in, maybe your credit's bad for whatever reason, okay? If you've got money in your policy, you are guaranteed to get a loan against that cash value without having to qualify. It's just built in, guaranteed part of the contract. So that flexibility is huge. And of course, you also can do the alternative by doing a withdrawal, right? But you have built-in guaranteed loan options. You also have the ability to go to a third-party lender. There are a couple of lenders that specialize in loaning on cash and insurance policies, where you can get access to loan, generally at a little bit better rate than a policy loan, right? And then what we're talking about is avoiding paying taxes on money you access. And when I tell you, it's a beautiful feeling, accessing as much of your money as possible without having to pay taxes, doing it all totally legally and above board, it is fantastic. It is fantastic. But again, my job is to show people options and how to be efficient. And I do that. And as I said, most will like it. Not everyone does. But at the end of the day, it is your choice on how you access your funds. Loans just happen to be more efficient, right? And, you know, just like most loans or a line of credit, if you've done it in your house, as we talked about in the beginning, you know, most people don't seem to have a problem with doing it that way. They like where they live. They don't want to sell the place. They're hoping it continues to increase in value. Notice I say hoping. And these days lately, especially in our neck of the woods, things like that have been happening. But let's face it, sometimes we have recessions. But if we flip over to a policy loan value will not decrease. A policy will not decrease because of loan value. Because understand that if you're doing it from the insurance company loans you out of their money. So the money in the policy acts as collateral, but that money continues to grow every single day tax-free. And if we have markets that are up and down like we have typically, that doesn't affect it because it's cash and it grows tax-free every single day. Now, yes, you do have interest that grows as well. But I tell you what, a beautiful thing to see, Genese, is seeing your interest on what you owe grow. If you choose not to pay it, it's totally up to you.
Right.
But seeing the access and your cash outpace that interest, right? Because one of the things people say is, well, how do I pay it back? If I don't pay it back, it could blow up. It is possible in the numbers, but in a lot of cases, especially when you're working with an advisor, right, who understands what it is that you're after and how to keep you within the lines, so to speak, you can actually access them, not pay a penny while you're alive, right? And actually, yes, what you owe will grow, but what you own will outpace what you owe in a lot of cases if set up right. And that is a beautiful thing because there's no stress. So when the end eventually comes, what happens is the insurance company takes their loan and interest, and then the difference, the residual, will go to your family or whoever you choose to, whether it's your favorite charity, if you're single, friends, whoever that is, tax-free. So beautiful, beautiful program, great options, great choices. And those are really the words, choices and options. Right? But again, if someone prefers to do a withdrawal, totally up to them. I like efficiency though, so I'm a loan guy.
Okay.
Right?
Sounds good. Yeah. Well, I mean, you've covered quite a bit. I'm not exactly sure what the viewers have to say. I mean, but we'll probably leave it open for them to ask questions if they have to ask questions. Because I'm sure after this presentation, there are going to be tons of questions rising. So I'm looking forward to being able to follow up with those comments. And but feel free to put your comments below that we can know what your comments are. I mean, I'm really curious.
Jenny, you're right. And Genese, I wanted to, I know time-wise we might be going on a little bit, but I wanted to show a little bit of a clip and add something, because as we go and retire, we're still going to need access to money for things, right? If our income stops, we'll need access to money. And maybe we have some money saved up and we think, you know what? What if I have to replace my car? Maybe I'll just go buy it cash, right? Maybe I'll make payments, because what if I can make more money on my cash than what the car loan is, right? And there's so many applications once you've built up that asset. And let me share my screen here just to give you an idea what I'm talking about. I've done this before. We've done this before, right? And I don't know if you remember this. A situation where we'll say you've got some money built up in policy, you're getting maybe 5% on that policy. You can access a loan, possibly at 6%, and people go, why in the world would you not just take the cash, and why would you pay money to a loan at higher rate than what yours is? And this is where having a compounding asset that increases in cash value daily, it's only 5%, but 5% on a bigger number every day becomes a bigger number. So over the course of maybe a 5-year period, you're looking at having interest earned in that, just on that 50. Now, at the end of the day, you could have an extra zero there. We're just going to say that 50 need to replace that car, right? So you're looking at having interest earned of 14,000 over that 5-year period. Well, if you'd taken a loan from your policy and paid off that vehicle and pretended that you were going to pay the regular payments that you would make over a 5-year period, you would end up paying about $967 a month over 5 years. That sounds pretty steep. It is pretty hefty, but let's face it, if you planned on buying a car and you possibly considered financing, you're going to be paying that. But here's the key. It's not the 6% rate, it's the volume. You're paying 6% on a decreasing asset, on a decreasing amount. So as you do that, even though it's 6%, your actual dollars in interest paid, just about 8,000. Your actual interest made on 5%, which is lower, 14,000. You could do the exact same thing with a policy loan and still be $6,000 ahead, have your car paid off, and you can put all that money back to your insurance company, have your policy paid off, a policy loan paid off, have your vehicle, and have made some money on a process. This is how powerful loans can be. I'm not going to go too far into it. I just wanted to show that, to show the adaptations that you have to do this, right? So let me leave it at that for this week, Genese.
Okay.
I've given a mouthful today, but thank you as usual for tuning into us and letting me share.
All right, great. And thanks for sharing, Glen. I'm sure this has been beneficial for a few people who had questions about taking policy from their loan. And that's all we have for this week. And we see you next time. All right, so bye for now.
Bye for now. Thank you.